Evaluating investment risk. Key insights for making informed decisions. Evaluating the risk of an investment is essential for any investor, as it helps understand the likelihood of loss and the potential for return. Every type of investment involves a different level of risk, from price volatility to macroeconomic and asset-specific risks. Learning to assess risk will help you make informed decisions and build a balanced portfolio that matches your risk tolerance. Below are some key factors and tools for evaluating investment risk. 1. Understand the types of risk. Before evaluating an investment, it's important to understand the different types of risks involved. Market risk, related to fluctuations in asset values due to changes in the overall market, such as stock market drops. Credit risk, common in bonds and loans. It is the risk that an entity cannot meet its financial obligations. Liquidity risk refers to the difficulty of selling an asset without significantly reducing its price. Specific risk, associated with factors specific to the company or sector, such as management issues or regulations. Macroeconomic risk, linked to global economic or political changes, such as recessions or interest rate changes. Identifying these risks helps understand what you are exposed to and select strategies to mitigate them. 2. Calculate expected return and volatility. The expected return is an estimate of how much you could earn from the investment, and volatility measures how much the value of an investment may fluctuate over time. Volatility is a good indicator of risk. The higher the volatility, the higher the risk. To measure volatility, investors can use tools like standard deviation or the beta coefficient, which compares an asset's volatility to the overall market. A beta above 1 indicates that the investment is more volatile than the market, while a beta below 1 suggests lower volatility. 3. Use fundamental and technical analysis. Fundamental analysis evaluates a company or asset's financial health and prospects by studying its financial statements, financial ratios, and market position. This approach helps determine whether an investment is solid and backed by good financial performance. Technical analysis, on the other hand, is based on historical price patterns and trading volume to predict future movements. Both approaches can be combined for a complete view of the risk associated with an investment. 4. Consider diversification to reduce risk. Diversification is one of the most effective strategies for reducing risk in a portfolio. By investing in different assets or sectors, you can minimize the impact of a decline in the value of a single investment. This is especially useful for reducing specific and market risk. A diversified portfolio can include stocks, bonds, real estate, precious metals, and other assets. This way, if one sector experiences losses, the performance of other assets can offset them, balancing your portfolio. 5. Evaluate your investment horizon. The investment horizon, or how long you plan to hold the investment, is essential when assessing risk. Short-term investments, such as day trading, often involve higher volatility and risk, while long-term investments, like index funds, tend to stabilize over time. If you have a long investment horizon, you can take on more short-term risk, as the investment's value will likely recover over time. On the other hand, if you need quick access to capital, you should opt for lower risk, more liquid investments. 6. Use risk assessment tools. Various tools and financial ratios can help you measure the risk of an investment, including Sharpe ratio, measures risk-adjusted return. A high Sharpe ratio indicates a better balance between return and risk. Value at risk, VAR, estimates the maximum loss you could experience over a specific period with a given confidence level. Debt-to-equity ratio evaluates a company's debt level, indicating how dependent it is on debt to finance operations. These tools provide a quantitative view of risk and allow you to compare different investment options in terms of risk and return.